The best long-term investing strategy should not make you guess the price of the stock market tomorrow. It should also allow you to take a vacation and still receive money in your bank account. And it definitely should not give you sleepless nights. So, if you agree with me, let's explore this strategy. You see, if you have to sell the shares of your stocks every time you need to pay for a personal expense, this seems like a pretty nerve-wracking deal to me. Or imagine having two houses in one city that you receive rent for and an earthquake strikes or there is a riot there. Again, not ideal. What solves these problems? The strategy of dividend investing. Dividend investing is the act of investing in companies in the stock market that pay dividends to their owners. A dividend is a distribution of cash that lands directly into your account regularly. Most companies and funds pay them every 3 months, some pay them every month. The idea is that because the business is profitable, it is rewarding its owners, which include you, with a distribution of those profits. The dividends are announced and paid on a per share basis. So if you have 100 shares of a company that pays $2 per share, you will receive $200 in dividends. As you have probably noticed by now, when that happens, you don't need to sell any of your 100 shares in order to get cash. You are receiving it straight in your account, distributed by the company, and after you get it, you still have the initial 100 shares. This is one of the most appealing qualities of dividend investing, as opposed to buy low, sell high strategy. You never have to lower your ownership in the company in order to make a profit. Before I continue with the reasons why this is my favorite strategy and why it is the best one for the average person, I have to be honest here. Nothing is perfect. So first, let's talk about the disadvantages of dividend investing. The first and the main one are taxes. Each time you receive a dividend, it is taxed. Now, at what rate or if it is taxed at all, it depends on where you live. However, the general idea is that since you're receiving the distribution, you owe taxes on it. Of course, you also owe taxes if you sell a company stock for a profit, because either way you are making money and getting it in your bank account. So if you want to use the fruit of your investments, you will probably have to pay taxes. The only way you don't pay taxes on your investment is if you have a stock that doesn't distribute dividends and at the same time you don't sell any shares from it. Another minor con of dividend investing that only applies to people who are not experienced in it is that sometimes you might fall for something known as an yield trap. The yield percentage is the percentage of the dividend compared to the price of the stock. If the price is $100 and it pays $5 in dividends, the dividend yield is 5%. A yield trap is a company that pays very high and attractive dividend yield but can't sustain it for long. Usually, they might be in a declining industry or have a lot of debt or something like that. Inexperienced investors that only look at the yield and not at anything else might fall for it, only to find themselves with the company eliminating the dividend because they can't sustain it any longer. There are ways that this can be easily avoided by just a few important metrics, but they are beyond the scope of this video and I teach people about them in my general content and in my investing program. Now, let's get to the advantages of dividend investing. The first one is that dividends are a lot more stable than share prices. The price of a stock fluctuates non-stop and depends on the psychology and mood of the market, the news, wars in the distant part of the world, what the finance minister said this morning, etc., etc. That's not the case with dividends. They are paid out of the company's profit. If the business sells more shampoo, you get more dividends. Period. Speaking of shampoo, here is a chart showing the price fluctuations of one of the biggest and most famous dividend pairs, Procter & Gamble. All the red squares point to a prolonged period of price decline. You can see the volatility. And I didn't even want to circle the small price fluctuations you also see on the chart. The price is constantly going up and down. And here is a chart of their dividends. This company has been paying increasing dividends for decades and decades. Throughout all the price fluctuations I showed you in the previous chart, they are depositing money in your bank account non-stop. Isn't that awesome? I mean, just compare the two charts and you can decide for yourself which one makes you sleep better. Another advantage of dividend investing is that the cash from your dividends can pay for your life, something you can't achieve if you are simply looking at a stock price increase on your screen. You get the money in your account and you decide whether you want to reinvest it to compound your wealth or pay your bills with it. Imagine how much more fulfilled you are going to be if you are constantly getting cash in your account, regardless of whether you spend it or reinvest it, instead of watching a line go up and down on a screen for years and years. The next advantage of the dividend strategy is that it is really a lot easier to pull off psychologically. A little side note here. You have to understand that investing isn't only a game of numbers and charts, it's also a mind game. If you can't sleep well at night with your style of investing, regardless of the fact that your buddy has great results with the same exact style, you will probably be screwed. You will make a mistake, you will panic sell, or at the very least, you will hate your life. When you invest for dividends, it's a lot easier to keep your emotions under control. If you have a stable company that pays you month after month, you won't be as obsessed with what's going on with the stock price. If it goes down, you are less likely to panic sell because you want to avoid further losses, even though the company has a sound business model and is just currently out of favor with the market. The opposite of that is the so-called FOMO, or fear of missing out. Imagine you buy company X. It doesn't pay any cash. You hold it for a year. It goes up 30%. You're now thinking, if I hold it just a little bit more, I might make 40%. Next thing you know, the stock crumbles. Or you have the reverse situation. You sell for profit, and right after you do, the stock shoots up another 30%. Now you feel like a fool. It's just an absolute roller coaster of negative emotions, which can be avoided with the strategy of dividend investing. Another psychological benefit is that dividend investing focuses your attention on the right things. When you invest only for price appreciation, you might get caught up in the latest trend or only focus on the stock price performance. However, dividend investors are much more interested in how the actual business is doing. As Warren Buffett famously said, you are not just buying stocks, you are becoming an owner in a business. When you need to assess how likely it is for a company to sustain or increase its dividends, you focus on metrics like free cash flow, payout ratio, interest payment coverage, and a lot of other metrics that I show my students and I also talk about in my content. You just become a better investor who is way more capable of evaluating a company's performance simply by shifting your goal and focus. An argument I often hear about is that if you own non-dividend paying stocks, you can simply sell shares and create passive income for yourself that way. While that is technically true, it's hard to pull off. When the price of a stock goes up, you have no idea whether it is going up exactly proportionally with their better business results or because of a little bit of hype. And so you might start selling shares, and after some time, because the price had gone ahead of the business fundamentals, it might start to stagnate. However, you've already been selling shares of the company and now you have less of them. And now you have less shares, they're not going up, you have no dividends, and you've got bills to pay. Not a fun place to be. With dividends, you let literally the best management teams in the world decide what part of the company's profit can be distributed to you without compromising the growth or stability of the business. And companies like Procter & Gamble or PepsiCo have been doing that successfully for literally many decades. So it obviously works. And not only is this strategy way better for your quality of life, but it is actually more profitable for you. A study done by Hartford Funds reveals that going back to 1960, 69% of the total return of the S&P 500 index can be attributed to reinvested dividends and the power of compounding. Also in the same study, it is shown that companies that grew or initiated a dividend have experienced the highest returns relative to other stocks since 1973, with significantly less volatility and drama for you as an investor. One of the main reasons for this is that companies that pay dividends are more disciplined in their money allocation because they have a commitment to the shareholders, which keeps them accountable. Also, a growing dividend signals that the business is doing well and is confident in its future. And the last benefit I will talk about is probably the most important and is what got me started investing with this strategy. There is something called dividend reinvesting, which means that when you get the dividend in your brokerage account, you can choose to buy more shares of the same or different company with it. That way, you will be using the company's money to buy more ownership in the same company or in another one. So your wealth can basically grow on autopilot without you adding more personal money in it. And if you decide to contribute monthly, the effect only gets stronger. It is also known as the compounding effect and is really miraculous once you see it. Here is an example with conservative numbers that are totally realistic. In the first case, the DRIP, which stands for dividend reinvestment, is off. If you invest $1,000 a month for 30 years, the final amount of your portfolio would be $751,000 and the yearly dividends you will be receiving will be $67,000. Don't get me wrong, that's pretty good, but let's see what happens when we implement the snowball compounding effect. We turn on the dividend reinvestment function and our dividends are buying us more shares, which gives us more dividends, etc. And here are the results. After 30 years, our portfolio will be worth $2,162,000 compared to the previous $751,000. And the dividend we will be receiving per year will be $180,000. The difference is staggering. And remember, this is done by investing $1,000 a month consistently, not by being a millionaire or winning the lottery. And the best part? Each month, you can decide whether you want to increase the compounding effect by reinvesting the dividends or get them in your bank account and spend them. The decision is yours. That gives you flexibility, for example, when you get fired, to not take the first job that is being offered because you have passive income coming to you every month. You can use it to wait for a few months for better opportunities, then find a job that you like and start compounding again. And then, once you have enough, you can stop working and enjoy the passive income from your dividends. The choice is all yours. So, as you can see, for all the reasons outlined in this video, I think that dividend investing is the best core investment strategy for the average investor who wants to build their wealth and create more freedom in their lives. Now, that doesn't mean that it is the only strategy or that you shouldn't use any of the others that we have talked about in this Investing for Beginners guide. I want to make sure you understand this because the internet is such a polarized black and white space that people rarely speak to you honestly and in a reasonable way. The reason is that by creating a division, polarity, and by attacking the other side of the argument, a creator taps into our tribal instincts and is able to gather more attention and make more money. This is an age-old marketing tactic that I know works, but I'm simply refusing to implement in the content I create. With that said, I want you to know that dividend investing is not the only thing a person should be using to build their portfolio, and the other strategies we talked about have their place. I personally use multiple of them. So don't get into this polarized worldview of either or and black and white thinking. It's just that for me, dividend companies and funds are the biggest part of my investing portfolio, and I also think that they should be the main focus of every investor that wants to achieve more freedom. Does that mean that you should not buy gold to protect yourself or buy non-dividend paying tech stocks for a few years so that you can make 100%? No, of course not. These are all legit strategies. But the end goal, the thing we are all striving towards, is a better quality of life and more choices and freedom for us and our loved ones. And I think dividend investing is the best way to achieve that. If you want more help with starting your journey towards investing for freedom, then check the links in the description for the ways I can be of help. In one of them, you will find my free investing masterclass, where I go much deeper into the dividend investing strategy. I compare it in great depth with other strategies, some of which we discussed in the current series, and I also show how anyone, regardless of their level of knowledge or prior education, can start building their wealth and invest for financial freedom. If you're interested in that or in other ways I can help you, check the description of the video.